Hello, everyone, and welcome back to week two, Property and Casualty Insurance. And while we have a national audience, I think especially a pretty big audience coming from California, Texas, Florida, this is a really big topic for a lot of people with some of these insurers starting to leave the states or decline coverage for people. So we expect quite a few questions here. And to that end, we brought a big expert here, Fred Huron here, to really support. Right, our team knows insurance, but Fred is like definitely a subject matter expert, so we're excited to have him here. Before I get into housekeeping, Keith, you want to do some introductions?
Yeah, sure. Great. Thanks, Chad. Appreciate it. Again, my name is Keith Johnson. I am a senior education specialist and financial planner with Benefit Financial Services Group. So essentially what I do is help folks plan for retirement, investment management guidance, strategies for estate planning, distribution strategies in retirement, and so on and so forth. And to all of you on the webinar right now, thank you again for attending. Just to learn more about how you can better protect your assets with property and casualty insurance. So at this point, I'll turn it over to Fred, who, as Chad had mentioned, is a subject matter expert in this topic. So Fred, I'll take it away.
For a long time, property and casualty has not been in the limelight. We don't get much attention, but with a lot of the craziness that's been going on in the country, especially in California and Florida, it's brought a lot of attention to my industry. And so not in a good light, but hopefully I'll shed some light as to why things are happening, what we can do to help control those issues in terms of availability of coverage. The premiums are going up for a lot of individuals, and it's definitely a crisis, not just in California, but for the rest of the country as well. So what is happening? So for those of you who aren't in touch with the pulse of the insurance industry, let's take a look at what's happening in my state of California. State Farm has stopped accepting homeowners insurance policies in California. A lot of you may be aware of that. Hartford discontinued writing homeowners insurance just this year. Not done yet. Another company here is a sixth carrier in stopping insurance in California. Allstate is a carrier that you might be familiar with that's not writing insurance in California as well. I'm not done yet. Guard, probably lesser known company, they've stopped writing insurance in California as well. Kemper exits California insurance in California as well. And I don't want to leave the rest of the country alone here. So Florida is probably next on the list. It's companies leaving the state. Some American Capital Assurance, Avatar Property and Casualty, Fed National Insurance, Florida Specialty Insurance Company, Guarantee Insurance Company Association, and well, I think I'm done. I'm not done yet. So we have Encompass, it's leaving the state of California, National General, Aegis. Have I scared you guys yet? Pacific Specialty, Stillwater, Rivington Partners is another company. Hippo. In northern Arizona, there's a lot of policies are being non-renewed due to wildfire risk. Texas along the shoreline, it's pretty difficult to get coverage there. I read one little quick statistic yesterday. About 20% of Floridians are going without homeowners insurance. That is just insane to have one of your biggest assets without insurance. But that's what the world is coming to. So just kind of try and get a pulse of everyone. We have a quick survey that we'd like to post here. If Chad or Keith can help put that survey and see if we can get some feedback on this, see what everybody's experiencing in terms of the industry, whether they're experiencing a substantial increase in premium, a moderate increase in premium, low to no increase, or trouble finding coverage. Even though I've kind of led with, there is a problem, be honest, we want to get some good feedback here, share with the rest of everybody.
Thanks, Fred. So I did just launch that a few seconds ago. We have a number of people already responding to it, but it should have popped up for anybody that's on a computer or laptop or tablet screen onto your screen right now. Let us know your thoughts. I'll leave it up for just a few more seconds. We do have responses still coming in, and then I'll close it out and share results with the group. Tell you on my side, I can tell you it's been substantial. I can tell you that.
Yeah. It's that's one of the things that I can do on my end is share with the sympathy of those calls where I get a high premium increases. Well, I get those too, and it's an unfortunate industry. Oh, okay,
So
okay.
I just shared results and closed it out. 45% of people agree with that. Substantial increase,
Gosh,
39% of
gosh.
people moderate, only 10% saying low to no increase. But we have 6 people that are just having trouble finding coverage, which I feel like I'm hearing more and more.
Yeah, that is it's a scary situation. So hopefully at the end of this presentation, we'll have a better understanding as to why it's happening, what we can do about it, and some tips and tricks that we can enable here. So I replicated the survey myself as well in my own community. I'm from Orange County, California, which is in Southern California, if you're not familiar. And I'm in Fullerton, and let me enable this presentation here. And I surveyed 131% participants. The results were very similar to what this nationwide poll was just done. A lot of people had a substantial increase in premium, and a lot of people who are buying new homes, especially in mountainous areas, they're having very difficult time finding coverage. Even a simple thing as auto insurance, you'd think it'd be as easy as calling an agent and getting coverage. It's not quite that case anymore. Lapses in coverage, tickets or accidents can make it a little bit difficult to find coverage, especially if you're buying a car brand new and you haven't had coverage. So just quick note here, at the bottom it says my car insurance went up at $300 a month, and this person has a great driving record. All right, so here is another display of showing what's going on in the country. I thought California had it bad. Texas has it bad as well. Washington, Arizona. I know a lot of the audience members from those states, so you have my sympathies as well on that. So on behalf of the industry, I apologize. Here's one more slide showing for the rate approvals that have happened in my state of California. You'll see some of the rate increases are starting at 65%. And this is rates that had been approved for a very small time period. So I'm sure there's been a lot more rate increases since then.
Hey, Fred,
Yes.
real quick on that. I mean, the typical in California, I mean, they have to go to the state commissioner to request a rate increase. I've heard the backlog's pretty bad as well. So it's not just what rate increases have already happened. There's still a backlog. So we can maybe expect increases to continue as these kind of work their way through and get approved at the state commissioner's office. Is that maybe an
Yeah.
accurate statement?
Yeah, so if you notice on bullet point 3, it's delays in rate approval is definitely a big issue that is happening in California. As things get approved, the market should start opening up back up, and the prices should start getting steadier. It doesn't mean that the cost is going to go down for certain policies, but it does mean that the availability will go up. And as there's more availability, there's more options, and hopefully finding a lower cost with a different company.
Right. Thanks.
All right. So, so I've shown you guys what is happening, not just especially in California, but as you saw on the map previously, in other states as well. So here are the 4 factors that are causing this. The first one is going to be catastrophic events, and I'll explain a little bit more in detail in the next couple slides. The next one is going to be inflation. The third one, as I'm sorry, I think it was Michael that was mentioning it, was the delays in rate approvals is one of them. And the fourth, which you might not expect, is artificial intelligence. And I'll have some slides which I think you'll find very interesting in regards to that. All right, so I'll be referencing these 4 points as we go on. So let's get on with the next slide and talk about catastrophic events. So in Southern California, where I'm from, well, I mean, pretty much the whole state, 2020 and 2021 was really bad in terms of fires. The fires that were closest to me were the Blue Ridge Fire and Silverado Fire. Some of you may remember some of those fires. During that time period, there wasn't a month that didn't go by where there wasn't ash or smoke in the air. It was a a bit scary, and felt like it would never end. So, prior to 2020, the average annual acres burned was about 754,000. All right, that's a lot, but let's see what happened in 2020. In 2020, we had the worst fire season in California history. Let that sink in California history. 4.4 million acres burned, 10,000 buildings destroyed. If that wasn't bad enough, 2021 was the second worst in California history. Again, that's in the entire California history. 2.5 million acres burned, 3,000 buildings burned. Not to ignore the rest of the country. In 2020, we had Hurricane Laura affecting Texas. In 2021, we had the Western wildfires in Arizona. 2021, Hurricane Ida was affecting Florida, 84.6 billion. So all of these are catastrophic events. So when a catastrophic event is an event that affects multiple properties or multiple areas all at once, and the insurance companies have a hard time absorbing and paying for these claims all at once, and it really hurt them. It really hurt them. Insurance companies have what's called reinsurance, where they buy insurance on top of their own insurance. And luckily, reinsurance did pay for a lot of these. But what ended up happening, just like it's affecting you and me, their reinsurance costs went up substantially. And that is a very big factor in why your insurance costs are going up. So the last couple of years have just been a nightmare for parts of the country, but especially in California and Florida. Okay, the next variable, as I mentioned, the first one was catastrophic events. The next one is inflation. The cost of things are going up. It's homeowners insurance, asphalt shingle costs have gone up 16%, concrete blocks have gone up 18%, drywall has gone up 20%. The cost of wages have gone up as well. The cost of fuel to get those trucks to rebuild a property have gone up substantially. It's just a fact of life, and something that has happened, has hit us more recently, as most of you have seen on the news, that the cost of living has just gone up quite a bit. Automobile repair costs are going high as well. As you can see from the chart, just between 2020 and 2022, it's gone up 18%. Until electric vehicles are more common, hopefully the cost of repairs for those vehicles will go down. But right now, it's really expensive to fix electric vehicles. If those vehicles have some damage to it, typically the battery has to be replaced. That's very expensive. Parts aren't as readily available as they are on other vehicles. Some training is involved with certain repair shops to fix these electrical vehicles, which is not always available. So it's just, so the rising cost of repairs, materials, labor, inflation is one of the second biggest factors as to why your insurance is going up. Okay. And so the next one, it's hopefully you'll find some humor in it. When I wake up in the morning, I watch Good Day LA, which is my local Channel 11 Fox television channel. It's about a 2-hour show, and on there they have commercials of attorneys during the breaks, which I understand. But I noticed, man, there was a lot of them on there. And so this is one example of one of the commercials that I've seen. But this isn't all of them. There's Fung Law, Dominguez Firm, Jacoby and Myers, Call Jacob, Larry H. Parker, Morgan and Morgan, Russ Brown, Larry Parker. These aren't, they're not, their services aren't unjustified, but their services have increased in that there's more lawsuits against insurance companies than ever before. So to maybe illustrate that example more, I took a survey just from February 5th to February 9th, from 7 a.m. to 9 a.m. Guess how many advertisements for legal representation there were against the insurance companies that I work for? 61. So if you can just imagine 61 commercials of attorneys wanting to sue your employer happening every 2 weeks, that's a pretty uneasy thing, but it happens in our industry all the time. And
I'll chime in too, Fred, real
sure.
quick. I took my son to a LA Sparks game for his birthday yesterday, and just driving down the 405. The Sweet James specifically, it's funny you put
Yeah.
that up, and it was basketball, and that's what I went to. I counted just for him alone, it was like 15 billboards on my hour and a half commute to downtown LA. And there's like three right in a row.
Yeah.
It's amazing just seeing that, and yeah,
Yeah.
it's
And
just a
yeah,
lot of litigation out there for sure.
there is those billboards, just one alone is yeah, I'm sure a pretty penny. And and when I spoke to a marketing rep from one of our major carriers, she said that the reason they're spending so much marketing is because they're making tons of money from the insurance companies. And again, I'm not saying it's justified or unjustified, but it is happening and it is causing an increase in your insurance premium. From 2010 to 2020, we're seeing a 320% increase in premium. So this is the money that's being out in the bodily injury of your auto insurance, where you see those numbers where it's bodily injury of, I'll do the most common one of $100,000 per person, $300,000 per accident, where on the homeowners, there's $300,000 of liability coverage. All of that pays to other people's damages. That's where the big bucks go to. And later on, I'll touch on the topic of an umbrella, which is going to be a very affordable and a very good coverage that you can ask your current agent to help coach you. That'll help protect your personal assets from these big claims that could be coming up. So we've covered catastrophic events. We've covered the increased cost of materials, inflation, the judgment inflation, the increased cost of payouts that have gone in regards to lawsuits. So let's talk about another reason for the rate increases. Now, this one is predominantly more in California. It may be happening in other states as well. But what happened in California between May 2020 and October 2022, the insurance commissioner said, because of COVID, we're not going to take any rate increases during this time period. Seems like a very noble thing to do at the time. But claims still happened. The rise of inflation still happened during that time period. Lawsuits still happened, and the insurance companies weren't able to get rate increases and get approval for get the appropriate premium for those policies. So there was a backlog. Last time I checked, there was a backlog of 96 rate rule filings. Hopefully, it's gotten a lot better since the last time I checked. And so what has happened is the other thing that's happened is a lot of individuals, they were driving very little during that time period because of COVID. So they were, instead of driving the standard 13,000 miles a year, they were driving 5,000 miles a year. And so when COVID ended, people started driving back to normal, driving a lot more miles, but that annual mileage, without the insurance company's intervention, stayed there at the lower mileage. Now, it seems bad that, seems like a good thing, no rate increases, the lower annual mileage. Why should we be paying more money to the insurance company? Well, when they're not collecting the appropriate amount of premium for it, then you start seeing some of those issues that we saw in the first couple slides where I showed you 10, 20 insurance companies leaving the state. And that's just how it is. So some of the other reasons that there's a backlog of rate filings in California is the insurance commissioner claims that the insurance applications are incomplete sometimes, although the insurance companies may dispute that. Also, just kind of inside info. In California, if you file a rate increase of anything below 7%, there isn't going to be a public hearing or an audit. So this might be a little sneaky, I don't know. So what the insurance companies will do is, instead of asking for the appropriate rate increase, which may be 15%, 30% or something like that, they'll ask for 6.9%. Once they get that approved, right away they'll ask for another 6.9. That way there's no public hearing, no major audit of their books. This has slowly started going away, as you saw in one of the prior slides with the table, showing rate increases much higher than that. So there has been some more flexibility in regards to allowing insurance company to ask for higher rate increases. As I believe Michael had mentioned, yeah, so there as these rate approvals are pending and the insurance company is like, hey, we're not collecting enough premium, what are we going to do about this? They're suspending the ability to make new policies. Some companies are asking for payment in full. A lot of the California people in the audience here, they probably ran into having to wait for 2 weeks or more to get a auto insurance quote or get a policy. Sometimes they require, in my opinion, it's a little silly. They're asking for copies of utility bills. But some less silly would be copies of the registration, photos of the home, and they'll do annual mileage verification. It wasn't too long ago, I used to be able to take the word from the consumer as to how much they drive per year. That's not the case anymore. It's something which I'll touch on later in the artificial intelligence or the data gathering, is they're able to get odometer readings when you take your vehicle out to get oil changed, and they'll recalculate the annual mileage for us. And it's usually hands off for me and the consumer unless we provide additional documentation. The other thing that's been happening is forced bundling of coverage. Sometimes product X is not available unless you buy product Y. Again, these are all things that weren't an issue to us a couple of years ago, 2-3 years ago. They are issues that are happening now. And so it's not all doom and gloom. I'll get you some ideas of how we can manage this later on in a couple slides here. So one of the other things causing before I get to that, so these rate approvals, the fact that they've been delayed and they're coming up, then they're all getting approved now all at once, is why you're seeing those rate increases now, because they're finally starting to kick in, some of them, and those backlogs are starting to get fulfilled, is you're starting to see those rate increases. So this one you may find interesting because you don't think about artificial intelligence having an impact on your cost of insurance, but it does, not just in availability rate, but there's also a lot of data gathering as well. So other states have what's called FAIR plans, but I'll talk about the California FAIR plan just because I'm more familiar with it. So the California FAIR plan is the carrier of last resort. They insure homes that are next to wildfires, difficult to write. They use what's called a Zesty as artificial intelligence for their information. So what's interesting is that they'll use aerial photography to see if there's trees touching the roof, if there's clutter around the yard, if there's an empty pool, it can be an issue. For those, the most recent ones that I've been seeing quite a bit is the insurance company, if they see stains on the roof, it's going to imply pooling on the roof. Now, is it being too picky? I would say it probably is. But I'm just making you aware of the tools that the insurance companies are using in regards to that. Now, I personally have not seen insurance companies that I work with use drones, but those I've seen come up on the news quite a bit, where insurance companies are now also using drones to take a look at your properties. But what's interesting with artificial intelligence is that the system will kick me out or prevent me from coding before I even see the property, before the underwriter reviews it. So it's basically a machine that's doing a lot of the underwriting from the start. So here's another slide. You know, one thing that is interesting about this slide here is they're showing 150 million data points on there. So as I mentioned in one of the prior slides, odometer readings, you know, nowadays, if you take your vehicle to go look at an oil change, we're able to pull up odometer readings. It's gotten so detailed that they can pull up the certain amount of, you know, let's say a certain amount of like Ferraris in a certain zip code. And they can also pull up all the individuals in the household oftentimes that have lived there, previously lived there. And if you're curious as to why they do that, is pull the information in the household, is they either want to collect premium for those individuals in the household or exclude them. The assumption is that individuals in that household have regular access to the vehicles. And I don't want to pick on Zesty too much. So here is another company that a vendor that insurance companies are using. It's Esri, and one of their wordings or logos, I should say, is gain hyper-local risk insights. What's interesting about this is because in the past, certain areas used to be categorized as uninsurable or insurable. And so a house that was maybe on the fence, I used to be able to insure it because it falls within that group. Nowadays, it's to the very house that can be insurable or not. So a house that was previously uninsurable due to brush, it probably is, but also maybe their neighbor that wasn't, that is now can't get that insurance. So it's on an individual basis. So it's very interesting. And I'll show in the next slide, I believe, that it's not always, two slides from now, I'll show that it's not always perfect. So as I mentioned, the California Fair Plan is the one using Zesty AI, and I'll read to you what one of their bullet points read. It says, while the adoption of Zesty AI provides more sophisticated approach to evaluating wildfire risk, it will result in significant changes to wildfire premium charged for some policies. To help manage this impact, annual premium increases will be capped at 50% for 2 years. So you know, artificial intelligence is one of the reasons why your insurance is going up. Now, you know, so as I mentioned previously, they'll do aerial photography, and the artificial intelligence will see it. So, for example, in this image, the artificial intelligence would have seen that there's a tarp on the roof. Those seem simple enough maybe for the naked eye. But the ones that surprise me is when I see a policy getting declined later on because the artificial intelligence said there was mold on the roof. And I'm like, okay. I look at the pictures, I can't even see it, but you know, their interpretation of it, you know, there's discoloration. Or there's the gradient is going, they can see that now. So so a house that would have normally paid an average amount of insurance because it's getting declined to this, now has to go to a different market and pay a different rate. So this one I thought was funny. So this one was declined a couple months ago by me because of an empty pool. As I mentioned, one of the things insurance companies don't like is an empty pool. So the system automatically declined me, and I'm like, I can't quote it. So I contacted the underwriter, and he said, it looks like the aerial image is taken on 1/12/2024, maybe mistaking the waterway behind the dwelling as an empty pool. So it thought that waterway behind was an empty pool. We got it remedied, so so it's 1 point for the humans on that one. All right. So hopefully you have a better understanding of what's happening in the industry. So If you get questions about, oh man, why is my insurance go up, or try to figure out, what's going on in the market. Hopefully that helped a little bit. So I think a lot of you guys want to know, how could we avoid problems in this market? So I'm going to give you some tips and ideas that can help in this matter. So missing a payment is seems like it happens to a lot of people. I get it. People get busy. If you're successful or not, people forget to make a payment. So sign up for automatic payments or pay your insurance in full. I sit next to the customer service department, and it happens on a daily basis where a client calls in and says, hey, I missed a payment. Can you take a payment? The answer is going to be no. There's not going to be a reinstatement. And on top of that, if the carrier may not even let us rewrite that policy. So we have to rewrite that policy with a different carrier that's at higher cost. So make sure your payments are done on time. If you're a busy person, sign up for automatic payments. If your mortgage company is in charge of your homeowners, making your homeowners insurance payment, just check in on it, 2 weeks before the homeowners is due, make sure that they've paid that insurance. It does happen where the mortgage company, something happens, they don't make that payment. The next thing is ask your insurance agent just an idea if this claim is worth filing. So 2-3 years ago, it wasn't an issue when there was a zero paid claim. Now it is. So what does that mean? So it hasn't been raining here in California recently, but let's say it was. Oftentimes what will happen is somebody will get a water leak from the roof, and they'll call the insurance company and say, hey, my roof is leaking. Is this something that is covered under my policy? And 99% of the time, the answer is no. Why is that? Because that's kind of wear and tear, more of a maintenance issue. And then you say, no, Mr. John, this claim is not covered. Goodbye. Everybody hangs up. But what happens now is the insurance company has created a claim on your record. It says water claim zero paid. As I mentioned 2-3 years ago, this wasn't going to be a problem. Hopefully it's not going to be a problem in the future, but it is now, where this claim is affecting your ability to find additional coverage. So if it's a large claim, please, by all means, call it. If you're unsure about it, talk to your agent first. Hopefully they're not afraid to kind of just give you an idea where this is a claim that's going to be worthwhile to file. All right. And the other thing is we need plenty of time to market your insurance. If your policy is expiring and you need to shop it around, long gone are the days where you called in the same day and we can get you an insurance policy the same day. Well, it does happen still quite a bit, but if we need to go to the fair plan, for example, often there's a 3-week waiting period to get a quote, simply because there's so many policies that they're requiring. If there's issues in regards to claims or other issues, I have to get multiple declinations before I get a company that will accept it. And these insurance companies, they're overwhelmed. I had one recently where it was over a month where I wasn't getting a quote on a home that had multiple water claims. And finally I had to say, please, we got to do something. The policy is expiring soon. So the moral of the story, start shopping early.
So Fred, right there, I'm just curious. I mean, high level, what do you look for in an insurance company for someone who is shopping around beyond the cost?
So, if they're a name brand company that you're familiar with, that's usually a very safe bet. Another thing would look up their AM Best rating. They have A rating or higher. But I am sad to say that even looking for those, it's just too difficult sometimes to find coverage with trying to find coverage with those carriers that you're familiar with, or with those carriers with the AM Best A rating. So if you have the flexibility, look for those things. You can go on the California Department of Insurance. They'll have complaint ratios for each insurance companies. Those tend to be more agnostic in terms of their surveys. because if you go to like Google or Yelp everybody hates insurance companies because the people that have the bad claims are the ones more predisposed to write the survey as opposed to the people that had the good claims. So the California Department or any Department of Insurance, I'm sure probably has similar surveys. But that's when you have a choice.
That's
When
great.
you're yeah.
That's great. Thank you. No, that's good. Those are
Yeah,
good
but
resources. Appreciate it.
having said that, if you're up in a corner, for example, the Fair Plan doesn't have a rating, it's better to have that insurance than not have that insurance. Okay.
Perfect. Thank you.
All right. So make sure the new policy is in effect, and make sure all underwriting is completed before canceling the old policy. So sometimes there's an overconfidence that you'll be able to find a new policy, or that the new policy is going to be issued without any problems, and he or she may cancel the old policy before getting the new policy. It seems basic, but I've seen it more times than you would think. So one scenario that happens oftentimes is that with some companies, it's not going to run what's called the clue report or the loss history report until the very end when you start collecting money. So you get to the point where you're like going to collect money. Gosh, there's that surprise, that claim that somebody forgot to mention about, or even sadly, a claim that was maybe from the prior owner that the current owner didn't know about. And so that kind of throws things into a different direction. So it's important that the new policy is in force, and before canceling the old policy, all the underwriting has been taken care of. So as I was talking, the other thing to mention is that the claims follow the insured. So if you had a claim at a prior home, that's going to follow you. Depending on the insurance company, if you had a claim on the home prior to you owning, that may or may not affect you. But in terms of the claim following the insured, that is always going to happen. In California, we typically look at 5 years of loss history. Just checking my time here. All right, so let's bring some awareness of potential problems in shopping around. And if you have these issues, you'll either want to deal with them or stay with your current insurance company for now until maybe things change or until you've had time to deal with it. So insurance companies are now wanting updates on many of the major features of the home. They're not messing around here. So for example, the roof, depending if it's composition or tile, they want that updated within the last 25 years. Electrical, heating, and plumbing. But the difficult part about this is that most individuals do not keep that documentation. We can sometimes find documentation from public records, but it may only be for the plumbing and not the electrical or the heating. I will say that this is not a unneeded request. Just like a vehicle, you want to maintain your home. So when somebody says, well, my roof is 40 years old, it's composition, it's not leaking. Well, you have to maintain your home. You have to show pride of ownership. You wouldn't go, 20,000 miles without changing your oil and not expect some issues. So they are expecting major features of the property to be updated. One lesser known issue that's coming up quite frequently is electrical panels from Zisco or Federal Pacific. These companies aren't in business anymore, but their panels are all over the country. And so if the insurance company goes out there and does an inspection and see these, they're going to want them replaced, and it can be quite hefty. If they are dangerous because they have been known to cause fires. I won't go into an explanation, but if you are concerned, simply Google Zinsco or Federal Pacific, and you'll get a lot more information, and they'll scare you on those more than I can. All right. The other issue, much less economic friendly to fix, are trees overhanging over the roof. The aerial photography will see that when they do the inspection, they really don't like that. Trees cause abrasion to the roof. They cause debris matter to collect on the roof, which then causes mold. Rodents can access the roof if there's trees touching the roof. Fire is a big exposure when the trees are touching the property at all, not just a roof or even too close to it. Get those trees trimmed. If you've got a million trees around your house that you're in love, and you don't want to deal with it, and you've got insurance, stay where you're at. Because if you shop at a new one, it may be an issue there.
Fred, I'm going to jump in real quick on that. For tree trimming, my mom's house in Irvine, she's got a lot of trees around her property there, and it's Irvine, so homes are right next to each other. But even though it's more economical than maybe a roof replacement, which could cost up to 25 grand or something like that, we got a quote on tree trimming for around $6,000 to $8,000 for those trees. And one of the things the service talked about was waiting till the winter to trim those trees, because it's going to be more economical to do that, just because you don't have to, the leaves and the trees are less to trim. So if anyone is looking into that, but it is same thing he talked about. Yeah, rodents coming from the tree to the roof and getting in and so on, and those things, and just being aware of those potential problems for sure.
Thank you, Michael. I actually didn't know that, so that's a tip that I'll save more for myself as well. The other one, just to add to that, as I mentioned, a lot of the AI is noticing mold on the roofs. Power washing, I've seen different rates come up to that as well. Some are charging $6,000 to power wash your roof. Some are $1,500. So shop around on those if that's something that you need to deal with in regards to the insurance. So other things to be aware of that could be potential problems is lapse in coverage. For most of you, this may not be an issue, but for some individuals who, let's say, have one vehicle and they sell their vehicle until they get their new vehicle, well, they think, well, I don't have a vehicle. I don't need this insurance policy. Let me cancel it. And then once I get my new car at the dealership a couple weeks from now or next week, then I'll get the insurance at that time. That's a problem. So insurance companies look at the lapse in coverage as an issue. And so when they're at the dealership trying to get that vehicle, they're going to have problems finding insurance. Oftentimes, from what I've been hearing, is that the dealership used to get offered temporary coverage. Due to the difficulty in the market, a lot of them aren't offering that anymore. And it's very difficult for me to find coverage for somebody that's in a dealership that hasn't had any prior insurance and they want to insure that vehicle. So in the case of that situation, what you can do, if it's just a week or two, keep that policy in force. If it's going to be longer than that, usually those policies can be converted into non-owner policies where you actually have no vehicle on there. And that would be good, like if you borrow a friend's car or something that's not living with you, that liability would protect you under that as well. I've also seen these non-owned auto policies for somebody that is a traveling salesman all over the country, and they don't necessarily own a vehicle. They'll have these non-owned auto policies. And also, it's kind of a no-brainer that at-fault insurance would be a problem, but also no-fault accidents are starting to be an issue now. If there's too many no-fault accidents, there could be a trigger for that 14 or 30-day waiting period to get a quote. Now, okay. I'm going to move on to the next slide. So I'm going to just make you guys aware of some non-standard products that you're going to be likely seeing more often just because of the conditions of the market. So I'm more familiar with the California Fair Plan, but I know other states have the Fair Plan as well, such as Texas. So the Fair Plan is the carrier of last resort. It's the carrier that we get when we can't get insurance anywhere else. Now, in the past, I very rarely wrote them. Now I'm writing them much more frequently, just out of necessity. So the Fair Plan covers other things, but it basically only covers fire. So that sounds great, but what that also means that it doesn't cover other important things. It doesn't cover liability. If there's a slip and fall in the property, or even if you're out walking your dog and the dog bites somebody, Fair Plan's not going to cover that. If a water pipe breaks inside your house, that is something that's not going to be covered under the Fair Plan. If there's a burglary or theft at the property, that's not something that's going to be covered under the FAIR plan. So this is stuff that would normally be covered under your regular homeowner's insurance, but not covered under the FAIR plan. So what do we do to help remedy that? We add an extra policy called a difference in conditions policy. It adds to the cost, but it's a very important, vital part. So if you know someone or have just a FAIR plan policy with no additional policy to it, please look into getting a quote for that with your current insurance agent. Often what happens too is we'll educate the client on the FAIR plan and the difference in conditions, and we'll get it issued the first year. 2-3 years down the line, they'll forget about the importance of that, and they'll just pay one and not the other. And depending on which one they decide to pay, there's going to be some issues there. The other thing that can happen is on a mortgage bill plan. Mortgage companies get confused when they get two bills from two different insurance companies. So they'll often not pay both. They'll just pay one of them. And oftentimes it ends up being the FAIR plan policy, and the difference in conditions policy ends up canceling. So in those situations, I always try to convince the client, hey, make yourself in charge of paying one of the policies and let the mortgage company pay the other one. The other thing to be mindful with the FAIR plan is the delay in quoting. I've run into issues where a homeowner's policy is expiring in 1 week, and I can't help them. There's no market out there. I've submitted the quote for quoting, but the FAIR plan is not going to release the quote for 3 weeks. In their defense, it's not because they're being lazy. It's just they're overwhelmed with quotes, and they really don't have a lot of employees at that organization. All right, so hopefully I've covered the major points of the FAIR plan. So the other type of product that you're just going to want to be familiar with in the current market conditions is the surplus line market. So these are what's called non-admitted markets. So these are companies that are not admitted, for example, in California, Arizona, or Texas. So it means that they're not part of the Guarantee Association. So if the company goes under, the Guarantee Association is not going to be there to pay for the bill. They are much less regulated, which is why they're willing to write stuff that the normal markets are not willing to write. Just some things to be aware of is that they usually require payment in full or financing. The issue with the financing, it can be quite a substantial amount of the cost. It can be sometimes maybe 15%. The other thing is that they have a minimum earned premium between 25 and 35%. So if you got a regular homeowner's policy, I'm just gonna, I don't represent farmers, but just because everybody's familiar with the name Farmers, if you get that policy for a month and you cancel it, you'll be reimbursed for any unearned premium. But with surplus line companies, they keep at least 25 or 35% plus the fees. It's not the worst thing in the world, but just be aware of that. And just because they're non-admitted, don't be too scared of these companies. It is an option. They often have great AM Best ratings. For my own personal experience, I haven't seen one of these surplus line companies go under, and they're usually under the guise of the name of the company that you're familiar with in California, but they just have a surplus line product that they use to charge appropriately. One common example is United States Liability Insurance. It's a Warren Buffett, Berkshire Hathaway company. They have regular products that are admitted USLI, and they have non-admitted USLI products, and they're both A-rated products. Just one is far less regulated and more available. All right, so how can we manage the costs of the insurance? Higher deductibles on the home. So when I first started in the industry, $500 deductibles were very common. Now, probably all of my properties are either $2,500 deductibles or higher. More and more, I'm seeing $5,000 deductibles, $10,000 deductibles. It's what's got to be done to keep the cost down. And to be honest, most individuals aren't filing a claim unless it's very large anyways. They're managing claims small on their own. And choose a deductible that's not going to create hardship. So I would guess 2,500 if you had some savings is not going to create too much hardship. But if 5,000 or 10,000 is going to create hardship, definitely stay away from those. If it's not, I would definitely consider that and see what it does in terms of saving, lowering the cost of the insurance.
And
Also,
Fred, real quick on that front, just I think that argues from a financial planning kind of standpoint. We talk about emergency reserves and having 3 to 6 months of non-discretionary emergency reserves available, and paying that deductible is part of that. So, I mean, if you have a $5,000 deductible, making sure you have emergency reserves of at least that amount. And so just be aware of, I mean, yes, you can increase your deductible on your home or your auto, but just making sure you have that money available if that were to happen, so you don't get in a bind. And I also had a question, Fred, on that. Like, if you have a $5,000 deductible and you have a claim that's $6,000 or $7,000, you kind of mentioned on a prior slide, maybe think twice about filing that claim and just pay out of pocket. Is there a range of where from the deductible to where there is on filing a claim that you kind of think twice about that?
there is no guideline, but in that example, it would be very obvious to me not to file a claim, because if it's a $6,000 payout and you have $5,000 deductible, that's really means you're only getting $1,000 in payout from that claim, and your insurance is likely going to go up for the next 5 years, or you may have difficulty finding coverage if you have too many. So it's a personal choice, but
And that claim,
yeah,
as you mentioned,
yeah.
follows you for 5 years. So it's, yeah, again, kind of think
Yeah,
twice.
yeah. But obviously, if it's a larger claim, that's what your insurance is for. Definitely file the claim. Typically, if you just have one claim, it may have your insurance go up a little bit, but it's not gonna non-renew the policy. So I'm gonna go a little faster, just because I'm running out of time here. So removing physical damage from older vehicles. For yeah, for me, 2004 doesn't seem that long ago, but that's about 20 years ago. If you go on Kelley Blue Book and look at the value of their vehicles, uh, everybody has their own preferences when they remove physical damage coverage. I'll give you an idea. So if it's under 3,500, usually we go liability only on the vehicle. And this tip helps with putting that vehicle with a younger driver. That helps lower the premium substantially. So it's common sense. If you get an 18-year-old kid a newer car, it's going to be more expensive. But if you get them an older vehicle that doesn't need comprehensive and collision, that's going to help quite a bit in the cost. Also, just a side note on that, often people, when they have a young driver, they think separating a young driver is a good idea because, if they're a young driver, they should have their own policy. That's never a cost-effective method. The cost ends up being higher because the young driver can't have the multi-policy discount, the multi-vehicle discount, and there's some issues in coverage as well. So that's never a good idea. For the home, we want to check, make sure you get all the discounts. If you have a central burglar fire alarm discount, a lot of companies are giving good discounts if you have a water leak detection system, that alerts you or turns off the water if there's a major leak in the house. If you have fire sprinklers in the home, and always shop around early and use an independent agent for options. So I'm an independent agent, which means that I have access to a lot of different companies. So I'm in sales, but it probably doesn't look like it if you're in my office, just because I'm remarketing policies all the time due to the non-renewals, the rate increases. And luckily, I have the option to remarket those markets, but it's a state of the market right now. So before I go to my next slide, I just wanted to give some quick tips before I wrap things up. Tip for everybody. So if you have a really large claim, like a fire loss, the insurance company just doesn't cut you a check for your contents. They want proof that you've owned it. So a quick tip is to video record your contents. Use your phone. Go around, open up your cabinets, your your closets, record everything. In a perfect world, you'd have a list of items and their dollar amount. That's impractical. Nobody does that. So this is the next best thing. Then upload it to the cloud. The other thing is back up your data like photos. I recently had a fire where the insurance company covered everything, but the insurance company isn't going to replace your photos of your family. So we can't help you with that. So back up those photos to the cloud if you can. Another, just kind of shoot off these tips here. Earthquake insurance. Earthquake insurance in California is a big thing. Flood insurance is important in other places as well. Just be mindful in California, the deductible tends to be high, 15% or so of the dwelling coverage. That seems really high, but what they do is they give you the loss minus the deductible. And in my own personal opinion, I am more afraid. Well, there's been a lot of fires, but there's probably it should be an equal fear to earthquakes than to fire. So I would definitely get a quote from your current agent. If it's manageable in cost, I would definitely get that. Umbrella policies. Umbrella policies are very important. The reason is they provide a lot of coverage for a very small amount of premium. I'm going to just throw out a kind of a typical number. $1 million of liability coverage will run about $300 or $400. And so if there's that big claim where maybe one of your kids involved in an accident and they cause a fatality, a long-term disability, that extra $1 million will help keep those attorneys away from your assets. And that umbrella starts at 1 million and it could go up to 10 or higher. And what's neat about that is the defense costs are outside the policy limits. So those attorney fees and everything that they use to defend you, it doesn't take away from that claim payment that's been made. Another tip is just be mindful on homeowners policies. There's only a small amount of coverage for jewelry. It's about $1,500 to $2,500. So when there's a theft and I get a phone call, it's not Fred, they stole my sofa, they stole my TV. They didn't steal that. They stole the jewelry. And all homeowners policies have a very small coverage for jewelry. So if you have jewelry of concern, oftentimes these are engagement rings and watches. Ask to see how much it would cost to schedule it. That way, if it's lost in France while you're on vacation, it's going to be covered under the homeowners policy. Last thing I'll cover is flood insurance policies. For a very long time, the National Flood Insurance Program was the only game in town, and their costs were very expensive. So be mindful that there are other markets available. So feel free to shop around if you're in the market for that. And one thing that people don't know is that flood insurance does cover mudslides as well. So if you're on a slope and you're concerned about mudslides, flood insurance is something that would be covered under that. So what's next? So in California, there's a lot of legislation going on. Governor Newsom signs executive order to strengthen, and the insurance commissioner has made a lot of recommendations. And are these making an immediate change? No. Is what's helping is having the backlog of rate increases or rate approvals. Moving through, that's helping open up the market. Obviously, customers aren't going to like it because they're paying more, but it's going to make the availability of options available where you can maybe shop it around to a different company that's going to have a lower cost. So nobody has the crystal ball as to when things are going to be better. We're hoping that near the end of the year, the market's going to start opening up a little bit more. Again, that doesn't mean that the prices are going to go down. It just means that the availability is going to be there and you're going to be able to shop it around and see if there's more options available. And the same thing is going on in other states as well, where in Florida, in Texas, the insurance commissioners doing everything they can. And all we can do is hope and pray that things will get better, not just for the consumer, but for me as well, who's spending every single day remarketing policies for due to those non-renewals or huge rate increases. I think I am done. If any of you guys want to take over here.
Yep. Thanks so much, Fred. Great presentation. I think we have a number of questions in the queue too for you. But real quick, I'm going to put in the chat box just for anybody. I know we are at the top of the hour. As much as we build these things for 90 minutes to make sure we can get through some questions, I know some people always do need to drop after the first 60 minutes. So I did put a link to our survey as well as the registration link to next week's webinar, the formula for feel good success, for anybody who is not already registered for that. With that, let me, as a reminder for the group, there's a Q&A box at the bottom of your Zoom menu. Again, we already have a number of questions in there, but please do look through them. Thumbs up any questions that really come to mind so we don't have a number of duplicates, because we do have a hard stop at the bottom of the hour right now. But let me get to this first question here, Fred. What's the insurance company's obligation on the amount of time they might need to notify you if they do not want to continue insuring you?
In California, it's about 60 days. So I've seen them be as down as little as 30 days. What happens if they get below that, they'll give you an extension of coverage, but it's never going to be like a 1 or 2 week notice.
And so the next one, with a lot of upvotes here already, if your neighbor has a tree in maybe the back of your house and the roots are growing onto your property and causing floor issues or flooding issues, what is the recourse you might have?
It is not something that would fall under the insurance product. It's more of a maintenance issue. So what I can add to that is, let's say that the tree fall from the neighbor falls onto your house. You would think that would be covered under your insurance policy, but that's typically not. That would be covered under, that's not covered because that would be considered an act of God. Now, if that tree was in bad shape and you've warned that neighbor, hey, your tree is going to be fall down soon, then you may be able to go after their liability coverage. But in terms of getting that tree out and all that stuff, oftentimes that's considered an act of God and not covered in the policy.
I would just add to that as well. If you live in a homeowners association, bring it up with your HOA. They may be able to step in as well and help out there.
And maybe get that warning in writing so you have proof of it.
Yep.
So next one I have here is, do you have any recommendations for accurate third-party services that might help evaluate if you have a claim? Additionally, any recommendations for navigating the different insurance policies, where this person per se is a rentor, and standard renter's insurance does not account for earthquake, flood, and fire damage?
So there's independent adjusters that are available that you can hire. What they do is they take a percentage of the claim amount. If you have an agent that is independent and willing to work with you, I would probably use them first as a resource, because if you hire an independent adjuster, it gets to be a very combative situation where nobody ends up being, sometimes nobody ends up being the winner. So talk to your agent, see, they should be able to help you, walk you through the process, especially if they're not getting back to you or having some issues. Let's see what the other part of the question. Any recommendation for navigating the different insurance policies? So again, an independent agent should help you make comparisons. So contracts can be very complicated. So it's not something that, and it's not easy reading. If you have trouble sleeping, you may want to pick up a contract and read them. But the other thing is the California Department of Insurance is able to pull up, allow you to see contracts and compare some policies. They have good resources there. And then the other part is I'm a renter, but my center doesn't account for earthquake, flood, or fire. Yeah, renters doesn't include those. It's usually less of an issue for renters because you don't own the building. But obviously, if you have your contents on the first floor or are worried about that, you can purchase those separately.
The next question I have here is, this person lives in a townhome and the drone might see repairs that need to be done outside of the property. Is there a limit of how much like a homeowners association dues can be increased?
I don't know the answer to that.
So I mean, I live in a condo too, and in most, at least in our HOA contracts, there is a limit. Like they can't increase dues more than 20% per year. That being said, there is the case for special assessments in the case of emergency, right? Where they might have to come through to every single owner and assess a one-time special assessment. So yeah, I think annual dues, there usually is some cap or limit on how much they can increase it, but there's no recourse on a special assessment.
I'll add to that that well, actually, all homeowners and condominium policies have what's called loss assessment coverage. As an example, let's say a recreation room or a cabana burned down, and they said Unit A has to pay $1,500 of your share, Unit B has to pay $1,500, or maybe it could be a more substantial. There is loss assessment coverage under your condominium policy that can help pay for that.
The next one I have here is it's a really, really good one. If you've upgraded your home, does it make sense to let the insurance company know?
It is. So it's not like something that has to be done right away. But the purpose of it is just to make sure that you have the appropriate dwelling coverage. So what we do on our end is we do replacement cost calculations where we type in the information of your property and it spits out that number for the rebuilds. And so let's say we've been insuring it for $1 million and you've done $200,000 in upgrades. We want to make sure we increase it. But let's say you forget, let's say you install hardwood floors. It doesn't mean that, well, you didn't let us know you had hardwood floors, you're not going to get hardwood floors. It's just really to determine that coverage number. So if it so happens that even with the remodel, that coverage number is still sufficient, you're still good.
Awesome. Next one is, this goes to auto insurance that you talked about. Is it common for auto insurance to put things like vandalism as an accident claim? This person lives in California, their rate went up due to this, and they want to dispute, but what would happen if they just left it?
So it is not common to have a comprehensive claim make your insurance increase, make your insurance go up. What they do is it's a little sneaky in my opinion, is they don't increase the rate. What they remove is like a discount. They'll remove like the superior clean driver discount. So when they remove that discount, they'll make that rate go up a little bit. If you're really bothered by it, a lot of companies don't charge for that, so you can remarket your insurance and hopefully get that price back down.
So I'm gonna tie the next two together. First one is more of just, I think one of our attendees wanted to share their experience. They said, joining AARP when they turned 50 is one of the best things they ever did. Like a variety of services for those people that are able to access AARP. But then they did also have a question. Any word if there's going to be a substantial increase or any problems on new policies with USAA for military people?
I have not heard of USA. I thought I did see.
Or sorry, AARP and USAA.
Okay. So in California, I cannot write a Hartford homeowners policy right now. So they have stopped writing in California. So we hope they come back. They have a great product for AARP members. Gosh, that membership is really cheap, like $15 a year or something like that. And it gives you a really good discount for the Hartford Auto. And you can still get the Hartford Auto insurance, but you're not getting the full benefit without that homeowners discount as well. So we can't write it for now, unfortunately, the homeowners anyways.
So the next one, this is somebody I think wanting to clarify or maybe even just share for attendees about umbrella policies. Just to confirm, you need to purchase full coverage insurance in order to get an umbrella policy in the first place.
So the term full coverage is a very ambiguous term. It can mean a lot of things to a lot of different people. What people most commonly believe full coverage on auto insurance means is that you have comprehensive and collision on a vehicle. So like the example on the 2004 Ford Explorer or something like that, that you have to keep comprehensive and collision on the vehicle for the umbrella. The answer is you do not. What the umbrella cares about is the liability portion, which is what is paid for other people's medical expenses, other people's property damage. So on the auto, you do have to at least have $250,000 of liability per person, $500,000 per accident. It may vary a little bit with insurance company, but that tends to be the most common. You do not need to keep comprehensive and collision. You do have to have a homeowner's renters or condominium policy, and often the minimum liability requirement on that is $300,000.
Fred, are there any companies that will write a standalone umbrella policy, like a Geico or what?
Yes, yes. I do
Okay.
them all the time. Yeah.
Oh, awesome. Okay.
And just so everyone's aware, I mean, umbrella, it's something we typically recommend. It's a cheap way to add additional insurance. I mean, from typically, and Fred, you can correct me if I'm wrong, but I mean, $300 to $400 a year for umbrella for like $1 million of coverage. And it's increments of $1 million typically, but
Yeah.
I mean, it sits on top of, think of it as an umbrella, it sits on top of all your other policies. And so if you blow through those limits, then it's there to protect you.
Yeah,
Yeah.
you're mitigating a ton of risk for next to nothing. If you're in a situation where there is litigation, you're getting sued, they can't go after retirement plans, IRAs, things like that. But if you're someone who's saved, you have after-tax accounts, things like that, or a home that's paid for too, Fred, you could probably speak to this, but that's low-hanging fruit. So that umbrella, you just mitigate a ton of risk for, like Mike said, next to nothing.
Yeah. And, BFSG is a great resources to grow your assets and grow your assets over many, many years. And it just takes one stupid claim where, you're innocently looking at a text message while you're making a right turn and you don't see this little girl or something like that. And, you kiss all your assets goodbye. And, as innocent as it was, unintentional, it's gonna wipe out all your assets. So an umbrella, it's costs very little in cost, and I believe everybody should get one.
Yeah, 100%.
Awesome. Next one I have here is, are there any state incentives or credits for replacing Zinsco/Federal Pacific panels or updating building features? I mean, this particular person's originally from MA, but I feel like this is probably a question that everybody on here would love to know.
Yeah.
And they know the state has certain tax credits available.
I am not aware of any credits for getting those panels replaced in California. The only credits I'm aware of in regards to insurance would be getting your property retrofitted for earthquake. Usually there is some state incentives to do that if to get your house retrofitted, but I'm not aware. I think I would have come across that in California just because I run into these silly panels all the time and they have to get replaced, and I haven't come across that incentive yet.
So next one is, how can I find out when a roof, plumbing, electrical was done on a home? The insurance company wants this information for their grandparents' house, and he just doesn't have it.
Yeah, it does. So there are websites where you sometimes can get the information. I'd have to get back to you because I don't remember that website, but you'd have to pay for a service. But it may not be useful to you anyways, because it's a service that I use all the time. And what happens is it'll pull up one of the four and not the other ones, or it may not pull up any information at all. So it's not the most reliable source. So in other words, you're probably not going to find it. You're just going to have to probably start shopping around for a different insurance company.
Before I get to the next question up there, so when I hear act of God, this is a good one. Right, not covered. Any insights on like the things that are most common that fall under this description, and any insights into how to potentially cover yourself from some of those?
It's it doesn't come up often. I wouldn't think about it too much. As long as it's a covered peril, it's covered. I mean, one would probably say an earthquake is an act of God, but as long as the policy says it's covered, it is. But it's typically things that have no warning that it can happen, nothing you can be cautious or preventative about. So the example I gave earlier was the neighbor's tree falling on your yard. That's something often that's considered an act of God. But lucky for you, it's not a denial that's used very often, thankfully.
Typically, I mean, FEMA would be stepping in as well at that point.
Yeah, typically I believe they would provide loans or something if there was a major issue or anything like that.
Yeah.
So I have two similar before I get to the next one at the top, because that really would be the highest voted. Is get back to umbrella insurance. Is can you have umbrella insurance with one company and your car and or homeowners insurance with a different company, or do they all need to be one?
Yeah, so most carriers require that all three policies be with the same company. I don't represent a AAA, but I'll use them as an example just because everybody's familiar with them. So they typically require the auto, home, and umbrella to be with the same company. But it doesn't have to be that way. So you can have your auto home with AAA and write your umbrella with another company that an independent agent like myself can help with.
So next one, this gets to, I think, a fun point you made that they're starting to count no fault accidents. If and when are no fault accidents counted against you, and why would that be changing? Like, I mean, you weren't at fault.
Yeah. So as I mentioned, it happens. It doesn't happen with all insurance companies, but what some are doing, they're being very sneaky about it. They're not saying, well, we're not charging you more for that no fault accident. What we're doing is we're removing a discount that you had before. So I don't make the rules, just telling how it is.
The next one I have that just got a thumbs up is how often should someone adjust their homeowner coverage to account for things like inflation? This particular person has a current policy, but I think that I need to increase the amount of coverage since it's, the house, value has increased, but kind of concerned that there might be drop in coverage,
Okay.
right? Just because a
So
roof is pretty old.
yeah. So your homeowner's insurance, if you've pulled up the last 5 years of the policies, in 90% of the cases every year that homeowners dwelling coverage should have gone up. If it hasn't, there's something weird with that company, but in most cases it's already gone up for you, so you don't have to think about it. But as I mentioned, in the case of maybe you've done some remodeling or you're just personally concerned that it may not be enough, just go to your insurance company or agent and ask them, hey, can you run a new replacement cost estimate for me? And they'll put in the information about their property and see if that dwelling coverage is sufficient. And what was the second part of the question? Something about the
It's
roof.
more so like, is there any chance if they try to go and update their claim, right? This person particularly has a pretty old roof, and I think that probably applies to a lot of people too. Is there any chance that going to update their policy, that they might get denied because of
Oh, I
something like a
see.
roof?
I see. I see. No, usually talking to your agent or making modifications to your policy has no effect on them re-underwriting the policy, so I would not worry about that.
The next one, I think this is more looking for just insights. What percentage of premiums for policies, right, tend to get paid in claims, and what percentage are paid in things like administrative costs?
Ooh, no, I'd be guessing, to be honest with you. Please don't hold me to that. If I had to, I'm guessing here maybe 85% are probably in claims, and then the rest is probably in administrative costs. A lot of the money that the insurance company actually make in investments that they make with the money that they have in hand. But it's quite more often than not that where their loss ratios are almost hitting 100%. So meaning what they get is what they pay out in claims.
Yeah, I mean, the insurance business is a very low margin business, and yeah, they're just trying to do good underwriting so they don't have massive losses. And yeah, like Fred just mentioned, I mean, the way they make their earnings is on that spread of reinvesting those uh
Premiums.
deductible, or yeah, the premiums and so on. So
So the next one I have is, what insurance, and I think they say necessity or required should renters get? And then secondarily, like, can you kind of explain the differences between a homeowners association versus owning your own home or renters insurance?
Yeah, so I'll explain all three real quick. Renters, all we care about is the contents in general, all the contents and the liability. So your stuff inside that you own and the liability or damage that you can cause to others, or like a slip and fall. With a homeowner association, it varies from HOA, but the most common situation is that the HOA covers the outside of the structure, and you are responsible for the interior. So you want to make sure that you're insuring the interior of the unit. And for the home is you're insuring the entire structure. So going from home to HOA to renters, you're needing less coverage in those areas.
So the next one, we only got two left right now, unless more come in. Is this person's moving from the UK to the United States from the UK, but really think just moving from anywhere. You're regarding auto, like, are they able to bring like a out of country auto claim certificate? Like, would it make any difference? They've been driving for over 20 years to kind of show that they have no claims on their record.
No, I mean, if you're able to get a California license, you're probably going to get a pass on everything, and they'll just run it, and you'll get no loss or no claim history credit on that one. So it becomes a problem when you're wanting to keep like an international license. That's when you have to get driving records from the UK. But if you're able to get your California license, you pretty much get a pass, and you get qualify for that, for all those discounts.
Yep. Next one I have here is what would be the best approach for insurance? Think same organization or new quote after an accident, right? And their insurance might go up. Like, will it go up no matter what? Like, regardless of the insurance company, would it be recalculated if they get a new car? Right? And any recommendations on just a website to quote for car insurance?
So all of those are variables that would impact on the cost of insurance. And I'll reemphasize again that most companies do not charge if you have a no fault accident. Okay, so if you have one of those, it's not going to make your rate go up. It may impact the availability of getting other coverage elsewhere, but I want to emphasize that. So, well, best approach if after an accident happened. If you can, probably stick around with that insurance company until the renewal. The reason is that if you jump ship, right after the claim, you're going to get charged for that claim right away. But if you've still got 7 months left in your current policy, just stick around with it. And just wait until you get that renewal. I mean, you're not going to escape it by shopping to a different company. Your company's going to charge you for it. The next one will too. And then just shop your insurance after that. Should it be recalculated after I get yeah, I mean, it's typically the surcharge is not done until the renewal, not when you get a new vehicle. And websites for insurance, there isn't a one go-to for websites, just because there's so many different states and so many different companies. I'm going to be a little biased and just make sure you go to an independent agent.
Yeah. I mean, to that point, guys, we do have Fred's contact information on the screen, right? You guys, everybody knows us. We do no sales on our webinars, period. But a lot of people are asking for just information on how they can contact you. I have been just dismissing those questions and putting a text that has Fred's email, but definitely take note if you have questions. Fred has volunteered his time to email and reach out. I can't say if you actually need his services, it would be free. Definitely not. But he has allowed us to share his email information so that anybody that wants to reach out can reach out to him. The next and currently last question I have here is still on car insurance. Does insurance follow the holder of the insurance or the vehicle?
So in most cases, it follows the vehicle. So if it may be different in other states, but in California, it's the registered owner that's responsible first, and then the driver. It follows the vehicle. Now, if you needed to rent a vehicle or something like that, the insurance would follow you as well. Yes, to answer your question, the insurance does follow the vehicle.
I love it. So that is the last question we have here. Fred, thanks so much for your time. Any closing remarks you have or last bits before we conclude this thing?
No, I'm glad. Glad to be doing this webinar. It's very interesting. I was talking to a screen, but it's nice to know that there was over 100 people watching me. So it's very interesting not to see reactions and faces. But the questions that I saw made me feel right at home, because these are the questions that I keep seeing frequently. And I'm glad I was able to answer them. And those questions, although they were answered to that individual, I'm guessing they're going to help out other people as well.
Yeah, agreed. Yeah. Thanks so much, Fred. Keith, Mike, thanks for being on and addressing some of the audience too. We hope everybody has a great afternoon.
Thank you all.
Thanks, everyone.